Hello everyone, I'm Mark Dutram and thank you for taking a few minutes to join us today. I want to walk you through how I'm thinking about today's macroeconomic environment and some of the recent updates that we've made inside the BayView portfolios. One important framing point to consider: we're now 17 years into this secular bull market, which began back in 2009. So historically, secular bull markets have ranged anywhere from about 4 years to, on the short end, to about 17 years on the long end, which is kind of where we sit today. That does not mean that we're at the end of the expansion, but it certainly means it's something that we got to be mindful about. So at this stage of the cycle, we believe it's really more common sense to emphasize diversification, valuation, discipline, and quality, even more than usual. So let me start with kind of the equity changes, and then we'll move on to the fixed income. In our international sleeve, we've transitioned from high profitability to a more core position. So high profitability had an excellent year, up about 28%. So now I'm thinking more about broadening diversification and improving overall valuations. So really, here's what's changing. We're focusing on diversification from roughly 500 securities to about 4,000 securities. We're moving down the market cap spectrum from about 100 billion average cap size to closer to 50 billion. And as importantly, we're moving into much more efficient prices. So the average price to book moves from about 3.4 times book to about 1.8 times. At this point in the business cycle, we're also reducing exposure to consumer discretionary by roughly 50%. As growth kind of expectations are slowing and valuations remain elevated versus their historical standards. We're shifting most of this weight toward financials and materials, sectors that currently show better earnings growth and prospects for more attractive valuation dynamics. And these are relative to their long-term averages. The country exposure between the two securities remains really consistent, with the top 3 countries being Japan, Canada, and the UK. When we look at emerging markets, we're doing something similar. We're changing from high profitability to more of a core position. So high profitability, again, was up about 32% in 2025, another really strong performer in the portfolio. And similar to international equities, this move focuses on broader diversification and better pricing. So we're moving from about 700 stocks to more than 6,300 stocks, and then slightly smaller average company size from about 200 billion down to about 160 billion. But the average price to book, again, declines from about 3.4 times book to about 1.75 times. We're reducing exposure in consumer services and technology. Those ones have done extraordinary. And we're increasing the weighting toward financials, which currently carry more reasonable valuations. The country composition remains similar, with the largest weight still towards China, Taiwan, and India. So after strong international performance, these changes will also, again, make our foreign holdings more defensive if we do see increased volatility. You know, a common question that we get is, why do we continue owning developed and emerging markets after really such a strong year? And 2 main reasons. Valuations remain more favorable internationally than in the US, which is still somewhat surprising to many investors. They were more than 2 standard deviations below the US when we moved there in the beginning of 2025, and they're still about 1 standard deviation below the US valuations today. The US has had an incredible run in security prices. And then secondly, the US dollar has been falling, which has boosted international returns and could probably remain a tailwind in 2026 as we see maybe further rate cuts in the US. We're not really doing any security changes in our domestic equity portfolio. And a couple of reasons that we feel the portfolios are already well positioned across the right sectors and the factors. I like to joke that we were more DFA than DFA was in 2025. And that is actually true for several years now. we've been leaning more heavily into the factors that historically, again, drive those long-term returns such as value and profitability and size. You know, that vector security ETF that we own currently allows the portfolio manager to more broadly diversify inside the ETF, which has been happening all year, again, as the cycle progresses. So it's rebalancing without any kind of tax consequences, which is nice. On the fixed income side of the portfolio, we are, we've kind of done that same thing, given the managers the capability to make adjustments, right? So again, another advantage of this ETF structure is that the manager can reposition the portfolio by buying and selling securities without generating taxable events, which is really valuable to you, on your taxable accounts. And they've used that flexibility to extend duration modestly to pick up some additional yield. They've moved more into the defensive part of the yield curve. They've increased exposure to investment grade and non-government securities where yields have been more attractive. And then finally, they've shifted between countries to take advantage of interest rate and currency change opportunities. So we continue to use a global core approach because it gives a manager that true go anywhere flexibility, and we believe that remains appropriate for 2026. You know, it's hard to believe in fixed income performance has been incredible. Global core, I think, was up about 6% last year, and then global credit was up about almost 7%. Well, I hope this gives you a little bit more clarity into our reallocation for 2026. You know, we so much appreciate your trust and your confidence. And again, our focus remains on the things that we can control, right? Like removing wrong guessing, letting the algorithms, lean towards the factors and letting that work, reducing costs by reducing turnover and lower active management fees, reducing taxes by employing more efficient ETF structures. And again, markets will do what they do, right? But we'll continue to focus on growing and owning good companies that have, again, above earnings EPS growth, and then trading at good prices, and then building portfolios that are designed to weather many different macro environments. So we appreciate you guys. We love you. Wishing all the best in 2026.